Why doesn't irrational trading break the market? Welcome to Behavioral Finance Notes. This channel is a public research log where I study behavioral finance, explore how investor behavior shapes markets, and document the ongoing process of building analytical discipline. In this first note, I want to start with a question that sits at the core of behavioral finance. If investors are often irrational, why doesn't the market completely break? Behavioral finance research shows that investors frequently exhibit systematic bias. They overreact to news, they underreact to information, they chase past performance, they hold losing stocks for too long and sell winners too early. Given all of these predictable mistakes, a natural intuition would be the following. If some investors are irrational, rational traders should be able to step in, trade against these mistakes, and earn easy profits. Over time, these trades should push prices back to fundamental values. If this logic were always true, persistent mispricing should be rare, and behavioral effects should quickly disappear. But in reality, many behavior patterns appear to persist over long periods of time. This creates an important tension. The central issue is not whether irrational beliefs exist. The more important question is whether mispricing can be safely arbitraged away. In theory, arbitrage seems simple. If a stock is undervalued, buy it. If a stock is overvalued, sell or short it. However, in practice, arbitrage is far from risk-free. Prices can move further away from fundamentals before they converge, and that movement can be costly for the arbitrager. There is a well-known idea, often summarized in one sentence. Prices can stay wrong longer than traders can stay solvent. This simple observation changes how we think about market correction. There are several reasons why rational traders may not fully eliminate mispricing. First, there is a fundamental risk. Even if an asset appears mispriced, new information may arrive that changes its fundamental value, making the trade uncertain. Second, there is what researchers often call noise trader risk. Irrational traders may become even more aggressive in short run, pushing prices further in wrong direction before any correction happens. Third, there are capital constraints. If arbitrageurs experience short-term losses, they may be forced to reduce positions or exit trades at the worst possible moments, even if their long-term view eventually turns out to be correct. Taken together, these forces mean that even rational traders may rationally choose not to fully exploit an apparent mispricing. This perspective suggests that market efficiency is not an all-or-nothing condition. Markets can be highly competitive and still allow some degree of persistent mispricing when trading risk, capital constraints, and institutional frictions limit the ability of arbitrageurs to act. In this sense, behavioral finance is not simply about irrational investors. It's also about the structural limits faced by rational traders. Understanding these limits helps explain why predictable patterns in returns, sentimental-driven price movements, and other behavioral effects can survive even in sophisticated financial markets. This idea does not completely resolve the tension between rational markets and irrational behavior, but it helps clarify why assuming perfect arbitrage can sometimes be misleading when studying real-world market behavior. In future notes, I will continue exploring how behavioral forces interact with institutional structures to shape asset prices. Thank you for watching Behavior Finance Notes.